Hi, and welcome to a special webinar. My name is Dan Timotich. I'm a managing principal at T2 Asset Management, and we're going to be soon joined by Rick Poole from the Hartford. Most of you are familiar with my videos and commentary where I try to provide some context around the markets and the economy. Today, we're going to be launching a new series of webinars that are designed to help educate you on various topics as you start to think about your future and your retirement. Our first topic is focused on the media's influence on investor behavior. We're living through some very challenging times right now, and many people are trying to understand what's going on. With everyone sitting at home, we're getting bombarded by 24-hour news cycles, and many people are scared of what's being reported. So I hope this webinar provides you with some things to think about. I'm pleased to have Rick Poole with us. Rick and I have known each other for about 15 years, dating back to my days at Hartford Investment Management. Rick is highly respected among the advisor community and spends a great deal of time helping advisors and clients cut through a lot of the noise and focus on what they can do to better achieve their long-term goals. Rick, thanks for being here. Rick, you and I and many of our viewers know that we're active managers, and by definition, that means we typically take defensive measures when appropriate, as we did back in the fourth quarter of 2018 and again in January of this year. But there are a lot of people that may be investing on their own or working with advisors that still may be subscribing to a set it and forget it type of strategy, a buy and hold strategy, if you will, which by definition means that they need to ride all of the ups and downs in the market. And when the market sells off like it has in the recent weeks, they obviously get scared and search for answers on what they should be doing. And obviously the media plays a big role in that. We all know that investing can be emotional, and certain headlines will cause people to react emotionally. So I hope you can help some of our viewers put some perspective around this and how dare I say, dangerous it is for people to make investment decisions based on media headlines. So welcome, and with that, I'd like to turn it over to Rick.
Well, thank you, Dan. Thank you for having me, and hello, everybody. So clearly, we are living through some interesting times that none of us have ever seen. Part of what we deal with right now is this massive influx of information, almost to the point where even if you're trying to avoid it, you cannot do it, as we're all walking around with these smart devices that ping and ding, and up come various news stories, not only economic news, which we're seeing all the time, also about the virus itself and the spread and the contagion and so on and so forth, and there are opinions all over the place. And so what we're going to talk about today is what's changed from a media perspective in the last number of years, and more importantly, what hasn't changed. So thanks to my friends from MIT, that is the Massachusetts Institute of Technology, they put together this presentation for us, pretty smart folks. This is with their Age Lab, which they've had up and running since 1999. And they do pretty much what the name suggests. They study aging on a global basis and help adapt products and services to consumers of an advanced age. And they do an awful lot of research. So in this case, of course, they're doing it on the media. So as you can see from this first page, this is simply called Media Replay. So let's jump into this. We'll walk through, we'll make some points, and we'll come out the other side and see what we think. So this first page right here, which they so wittily called Deja News, these are headlines going back to the early 70s. And I'm going to walk through and point some of these out. Like, for example, this first one here in March of 1972, is the U.S. going broke? That could have been a headline from March 13th of 1972 or any day since. I wouldn't be surprised if we see this headline next week. This second one, Social Security's coming crisis. Did you guys hear about this? Right, same thing. This could be a headline from any time period between then and now. The economy's high blood pressure. There's no way out of this unemployment crunch. We might see that one next week. Exploding federal debt. Why so dangerous? Is the recession over? Joblessness is here to stay. Oil's drop and economic fears from January of 15. How Donald Trump could create a financial crisis. All the way to this most recent one, world shudders as coronavirus threatens global supply chains. The reason they call this Deja News is that every one of these headlines can be from any one of these time periods. The point being, there's no real new news. It's just old news recycled with new numbers. And so what does that do for us as investors? Three things. One, at a minimum, this causes us to be anxious. It freaks us out, me included on occasion, because you can't escape all of this stuff. As investors, what it causes us is to make mistakes. The biggest one right now that we see is, for example, I'm scared to death. Please sell everything, put it in cash. You have to be awfully darn lucky in order for that to work out, financially speaking. And that's primarily what we're here to do in our daily roles, and why we're doing this webcast, is to come up with solutions and ideas on what to think about. So those are all the news cycles. Again, there's no real new news, which is why we're calling this Dejan news. It's all old news, recycled with updated numbers. And part of what we experience today, versus even 10 years ago, is that there is this daily storm of media, which is what this big tornado of headlines says on the left-hand side. And on the right-hand side, it essentially says we're getting a lot more of our information from online and social media. And to my point earlier, it's getting to the point where it's almost inescapable. And human nature is bad news sells. That's why there's so much of it. If you watch the local news each day, the lead story 2 or 3, they're never good news. It's the most horrible things that happened that thankfully didn't happen to you. And the same is true in the financial press. So when you see this chart right here, back in 2009, back when the world was melting away again for a totally different reason, is CNBC viewership, which is what this is, spiked to an all-time high. It was really bad news, and we couldn't look away. Just like a train wreck or a car accident on the road. That's how we get rubbernecker delays, is it is human nature to want to take this information in. And when we update this chart for what we're experiencing today, we're going to see the same thing, right? Online viewership and viewership of news channels like Fox News or CNBC or CNN, they're all going to spike. We're going to see another one of these big red lines up here. And same thing when we search online over here on Google Trends. When we see how many times the word coronavirus has been researched in the last couple of months, it's going to be pretty significant. And so ultimately, here's the point, is there is clearly an urge to panic, which I totally understand. This chart on the left, if we could do this presentation with just one chart, this would be the one. It takes us back all the way to January of 2007. And there's really two important things to look at here. One is this little blue mountain, which initially drops off through the downturn of '08 and then continually recovers for 11 consecutive years. This is a period of time where the S&P returned just shy of 500%. That's through the end of 19. It's clearly 25% lower than that right now. But this red line, this is U.S. investors getting out of equity mutual funds month after month after month after month without interruption, which this would continue certainly through today. There's been a massive sell-off. Is why, if we can all agree on this point, because I think all of our financial goals are ultimately the same, which is I just don't want to run out of money, right? Does that about sum it up? I just don't want to ever run out of money. Does getting out of equity mutual funds during an unprecedented bull market run, month after month after month, does that sound like the formula to power a portfolio through retirement and beyond when the equities are performing to that level? And the answer is, of course not. Right? So what's changed? If we could take this data all the way back to the early 80s, which is really the earliest reliable data on investor behavior, is you would traditionally see after a downturn, you would see 2.5 years of outflows before investors realize, once again, it's not actually the end of the world, and they start getting back in. That didn't happen in this case. And the reason, and this is what MIT tells us, the reason it didn't happen this time is because the news is so omnipresent. It's literally everywhere. And this quote on the right-hand side, I really enjoy this, from Michael Lewis. How many times does the end of the world as we know it need to arrive before we realize that it's not the end of the world as we know it? And, the 1.9 trillion that came out of equity funds, as you can see, pretty well matches up to the inflow, 1.8 trillion, over to bond funds. And they've actually worked reasonably well in the last decade as well, as interest rates have stayed low and actually come down a little bit. But it's nowhere near the returns that equities provided. And it's very unlikely we're going to see those returns from fixed income, for the next 10 or 20 years, just given where interest rates are. So you see this big red panic button here, and this hand all full of news headlines about to hit it, is there's always a reason to panic. And so I was born in 1970, and so this chart conveniently kind of tracks what's happened in my lifetime. And when we say panic markets, an official bear market's a 20% downturn. Panic, MIT decided 30% or more drop. There's your panic button. And so when you look through these, during my lifetime, is in the early 70s, it was a 45% downturn, which is not insignificant. They tossed in 80 to 82, 20% drop. Notice there's no panic button, but still 20% is eye-opening. 1987, which look how briefly that lasted, by the way. That was only 2 months, a 33% drop. And then interestingly here in the early 2000s is when we started the end of the dot-com era, we dropped into a recession, is from September 2000 to September 21st of 01 was a 35% drop. Of course, the attacks were included in there. And then we had more than a 10% recovery before another 33% drop. So all in, with the recoveries in these two drops, we dropped 54% during that period of time, and it lasted a long time. It was 2.5 years. It felt like it would never end. And then, of course, we recovered, as we always do, and then along came 2008, where the world ended once again with a 50% drop, and then a recovery that was more than 10%, and then another 27% drop at the beginning of 09. All in, that market from top to bottom was a 57% drop, which is almost twice of what we've experienced so far anyway, as I'm recording this for you. So, there's always going to be a reason to hit the panic button. And I find this stat interesting. It's not in the brochure, but America's 32-0 in these situations, meaning 32 times we've had a drop in the Dow Jones of more than 20%. And if we wanted to walk through them, which I don't, they've happened for 32 different reasons. And the only thing they have in common is a recovery every single time. So I don't want to bet against 32-0. I believe strongly, and so do we here at the Hartford and T2 Asset Management, that 33 is coming. Maybe it's already here. I don't know. The market could certainly fall further from here. But number 33 will arrive. And so this is a really interesting chart because it does a couple things for us. It takes us all the way back to 1970. And it gives us a scenario of what if we put $10,000 in the S&P and reacted in different ways to all of these different horrible headlines that you see in these Time magazine covers, all the way up to and including today, February 17th, with President Z there with his face mask on. And here's what we discover. If we put $10,000 in and just ignored the news, didn't do a thing, as of the end of 2019, that 10,000 grew to 1.4 million. All right, that's not bad. What if we took a balanced approach and just did 50-50 stocks bonds? That 10,000 grew to 907,000 with a smoother ride. Right? If we just threw it into bonds, it was 351. We put it in cash, it went essentially nowhere. Inflation adjusted anyway to 136,000. And this reactionary investor, which essentially is we put money in the S&P, if it drops 30%, we take it out, then we wait 2 years, we put it back in. It grew to 732,000. So clearly, 1.4 better than 900, 900 better than 732, significantly ahead of 351 and 136. So it'd be interesting to see during this time period if you had a portfolio that was, for example, 70-30, and as we went through a period of time like this, if we rebalanced it, which would mean during periods of big market drops, we'd be buying more of the right thing at the right time, and I suspect that would have worked out pretty darn well. And by the way, buying low never feels good, because it never feels like whatever environment we're in, it feels like it's never going to end. And that's what we're all feeling right now. So I understand that, but you go through all of these headlines and some pretty serious events happen through here. Is just putting it in and sticking with that plan was by far the best result. And so this chart basically just says the market's up more than it's down. Psychologically, of course, it doesn't feel that way right now. But, 73% of the time, the market is up, which I don't know how much good that does us when it's been down for the last 6 weeks, and it feels like that's not going to end. However, the reality is, all the way back to 1926, is it's up a heck of a lot more than it's down, with an average of 10%. And so, the one thing we're not really good at, just because so much of today's headlines and stories are bad news, is we're not that good at optimism, right? So what are some things as investors that we have to be optimistic about, especially in the time where it feels like everything is falling at the same time, which, by the way, isn't true. There are some bright spots, but that's the way it feels. And so these are just some modern technologies today that, hey, these are ultimately good from an investment standpoint, right? So this med wand, which you can hold in your hand, and it takes all of your vitals and can send it to your doctor. That's a pretty cool little device. This mood ring for your dog, not so sure about that one. I don't know that if I really would even want to know what mood my dog is in. I think it'd be more instructive if my dog could understand what mood I'm in, right? And then this transformer guy, this is fascinating technology, especially given the massive increase in warehousing we've seen as we're all ordering things online, that can take a regular person and make them 5 times stronger as they're moving items around in these warehouses. That's a pretty interesting design. To the chair on wheels, to the inkjet printer for your face, to the screen protector that kills germs. I imagine that technology is going to see a serious increase in sales. Point being that ultimately, and this never changes, the reason markets rise over time are people, capital, and ideas, right? People, because we buy stuff. Capital, which is just access to money, which right now it's really, really cheap. As most of you know, as you've probably refinanced or you have a 30-year mortgage at 4.25%, if not lower. But ultimately, it's ideas. And as ideas come to us, between the genesis of an idea and bringing it to market and selling it, that's where the profit is. Think of the fact that Steve Jobs held up the first iPhone before the world in 2006. That wasn't that long ago. Facebook came along in 2008. Those types of ideas are what drive profitability over time. And ideas don't stop even when we're going through environments like this one. And so the bottom line here, before I turn it back over to Dan, is don't go it alone. You have a much greater chance of success when you have a professional. You start with a plan, which most of you who are listening to this have one. Stick to it. And then it's long-term behavior. It's having the perspective to do the right things in the face of extreme adversity, which we're clearly having right now. And by the way, folks, it's not easy. So hopefully some of that was helpful. Those are the things that MIT has to say about this. And with that, I will turn it back over to Mr. Timitich.
Thanks, Rick. I really do appreciate it. I really think this is a good presentation to frame the idea of investor behavior. And it's interesting. I was thinking about this the other day, Rick. Back when I took my CFA exams in late 1990s. I can't believe it's been that long. But back then, behavioral finance was such a small topic within the program. And then you fast forward, 20 some years later, and now it's a really important part of the CFA program for all the reasons you just addressed. And I really do appreciate you coming in and doing one of these for our clients and for our viewers. As always, if any of you have any questions or you want any more information on this presentation or some others that we'll be doing in the future, by all means, call me or send me an email. You have the information right there on the screen. I really do appreciate the time you took to watch this, and we'll continue to do more of these as time goes on. I appreciate it. Thanks, Rick. Thank you very much.
Yep,
Have
my
yourself
pleasure.
Have a great day.
Thank you.